Have you ever imagined a company losing $120 billion in just one day? Not in cash, but in how much people think it's worth. That's exactly what happened to Facebook on July 26, 2018. But how did the world's most famous social network suddenly lose so much value? What went wrong, and why did investors panic? On that day, Meta Platforms, the parent company of Facebook, released an earnings report that shocked everyone. User growth was slowing, and revenue wasn't as high as expected. So investors reacted fast, selling shares, and in just a few hours, Facebook's stock price collapsed, wiping out $120 billion in market value. In this video, Project Meltdown will break down exactly what happened, why it mattered, and what lessons we can learn from this historic market crash. Don't forget to like and subscribe to stay updated with more incredible tech stories. What exactly happened? In July 2018, Facebook surprised the world. Although the company announced that its user growth, the number of people logging in every day, was slowing down more than anyone had expected. For years, Facebook had been the most popular social network on the planet, connecting billions of people. So when growth started to slow, it sent a shock through the stock market. Investors immediately became worried. They had been expecting Facebook to keep growing fast, which meant making more money from ads and staying dominant in social media. But now, those expectations were being challenged. As a result, Facebook's stock price crashed almost instantly. In just a few hours, the company lost roughly $120 billion in market capitalization. That's the total value of all its publicly traded shares. To put that in perspective, $120 billion is more than what many huge companies earn in a full year. This wasn't just a minor drop. It became one of the largest one-day declines in US stock market history at the time. Why Facebook's value fell so fast. 1. Slow user growth. Investors were shocked when Facebook revealed that the number of people using the platform every day wasn't growing as fast as before. The social network was still huge, but it was slowing down, especially in key markets like North America and Europe, where most of its money comes from. This drop in growth made investors nervous. They started asking questions. Could Facebook continue to make as much money as before? Would user engagement keep declining? These doubts caused many investors to sell their shares quickly, which pushed the stock price down even further. 2. Earnings weren't as good as expected. In the second quarter of 2018, Facebook released its earnings report, and the news surprised many people. The report showed that revenue growth, the money Facebook earns from ads and other sources, was slowing down. For investors, this was alarming. They don't like surprises, especially when the numbers are worse than expected. Suddenly, doubts about the company's future earnings spread quickly. Many investors decided to sell their shares to avoid potential losses. This wave of selling made Facebook's stock price drop even faster, adding to the shock across the financial world. 3. Competition was growing. By 2018, Facebook wasn't just dealing with slow growth. It also faced strong competition from newer apps like TikTok and Snapchat. These platforms were especially popular with younger users, a group that is very important for social media companies. Investors began to worry. Was Facebook starting to lose its influence over key audiences? These fears spread quickly in the market. Many people rushed to sell their shares, which caused the stock price to fall even further. Yet the combination of slower growth and rising competition made that day one of the most shocking in tech and financial history. The market reaction. When the stock market opened on the day of Facebook's announcement, traders immediately started selling shares. The news of slowing growth and lower revenue scared many investors. This rapid selling caused the stock price to drop automatically, which made more people nervous. Some investors had bought Facebook stock on margin, meaning they borrowed money to buy it. As the price started falling, they were forced to sell quickly to avoid even bigger losses. This created a snowball effect. The more people sold, the faster the price fell. By the end of that day, Facebook's stock had fallen sharply, and the company lost roughly $120 billion in market value in just a few hours. To put it simply, That was one of the largest one-day drops in U.S. stock market history, showing how quickly fear and uncertainty can move even the biggest companies in the world. How does a company lose market value? Before we go further, it's important to understand what market capitalization, or market cap, really means. Market cap is the total value of all a company's shares that are available on the stock market. You calculate it by multiplying the stock price by the number of shares the company has. This is why Facebook could lose $120 billion in one day, even though it still had the same amount of cash in the bank. When the stock price falls because investors sell shares, the market cap falls too. It's not money leaving the company, but a change in how much investors think the company is worth. This is exactly what happened to Facebook in July 2018. Fear and uncertainty caused a massive sell-off, dropping the stock price sharply, and the company's market value shrunk by $120 billion in just a few hours. Why $120 billion is a massive number? To really understand Facebook's $120 billion loss, let's put it in perspective. That amount is more than the entire GDP of some countries. It's also more than what many huge companies are worth. Losing that much in a single day made headlines all over the world. It's important to remember that this wasn't cash disappearing from the bank. Instead, it was a drop in how much investors thought the company was worth. Even so, the effect was huge, both financially and psychologically. It showed just how powerful market expectations can be, especially for a company as big as Facebook. Aftermath. What did Facebook do next? Even though the stock loss was historic, Facebook didn't collapse. Instead, the leadership worked to reassure investors and refocus the company's strategy. Some of the things Facebook did after the crash included: 1. More focus on privacy and safety. After the 2018 shock, Facebook promised to make the platform safer. They invested in privacy tools and stronger safety measures to protect users. The goal was to rebuild trust and keep people from leaving, showing that the company was serious about improving its service. 2. New revenue streams. Facebook started focusing on more than just ads. They expanded e-commerce features, grew the marketplace, and connected Facebook, Instagram, and WhatsApp better. These moves aim to bring in more money from different sources and regain advertiser confidence, helping the company recover and reassure investors over time. 3. Rebranding to Meta. In late 2021, Facebook Incorporated officially changed its name to Meta Platforms. This was more than just a new logo. It showed that the company wanted to grow beyond social media, moving into areas like the metaverse and artificial intelligence. The goal was to signal to investors that Meta was future-focused and willing to invest in new technologies for long-term growth. At the same time, this shift came with new challenges and costs. Building these futuristic platforms required huge spending, and at times it caused stock market volatility, reminding everyone that even big tech companies face risks when trying something ambitious. What investors learned from the crash? And this event taught the business and financial world several important lessons. 1. Growth expectations matter. Big tech companies, worth hundreds of billions, rely heavily on future growth. When investors see that growth slowing, even giants like Facebook can face massive stock declines. 2. User engagement is key. Social media platforms like Facebook thrive on user engagement. If people start using the app less or spend more time on competitors like TikTok, the company's revenue can slow. This worries investors because less engagement today can mean lower profits tomorrow, affecting the stock price. 3. Diversification is important. Relying too much on one way to make money, like ads, can be risky. Companies need to innovate and create new income streams to keep growing and stay strong over the long term. Long-term impact on Facebook/Meta. After the 2018 stock crash, Facebook recovered and continued to grow, eventually becoming one of the largest tech companies in the world. Yes, but that day was a wake-up call for both the company and investors. It showed that even giant companies are not immune to fear and uncertainty in the market. Share prices can drop very quickly when expectations aren't met. The event also changed how investors looked at big tech companies, focusing more on realistic growth, and steady profitability rather than hype or past success. It reminded everyone that no company is too big to fail in the market. A look back. What this tells us today. The $120 billion loss wasn't the end of Facebook. Instead, it was a moment where reality clashed with investor expectations. Facebook had been a dominant force for years, but that day reminded everyone that nothing in tech is guaranteed. Today, as part of Meta, the company balances its established social media platforms with new investments in technologies like the metaverse and artificial intelligence. While its market value has gone up and down since then, the lessons from that historic day remain clear. Even the biggest companies must adapt, innovate, and manage expectations to stay successful. Closing thoughts. So, what can we really learn from the day Facebook lost $120 billion? Is it just about a falling stock price, or is there more to the story? This event reminds us that financial markets are driven by expectations, growth naturally slows as companies mature, and investors can react very quickly to surprises. Even the world's most valuable companies are not immune to tough times. How they respond to these challenges can decide their future, whether they bounce back stronger or struggle for years. Facebook, now Meta Platforms, showed the world how a company can face a shock, adapt, and keep moving forward. If you found this story fascinating, ask yourself, what other tech giants have faced moments like this? And what can we learn from them? For more deep dives into shocking tech events, like this video, subscribe to Project Meltdown, and tell us in the comments what story you want us to cover next.